All right, let's kind of get started here. We'll go over a few things. I honestly don't know yet who won round two. How's that? I mean, I've ran it. I've kind of looked at some things and on, but I haven't plugged it into my spreadsheet yet to see, because I know we had a few different things as I looked at it, who led in earnings per share, this, that, and the other thing. You know, I kind of have some ideas, but I'm not 100% sure, so it'll be interesting then to plug this into the spreadsheet. I'll show you guys what I do and how I come up with the winner in that case. So let's first take a look at last week's assignment. Okay, I want to go through prior week's assignments so that you guys can get a better idea of what I'm looking for. Okay, so I know that the first few assignments, you guys might not cover what I want exactly, and maybe several, but hopefully as it goes on, you'll get a better idea of some of the things that I look for. Okay, and you know, how to answer, et cetera, et cetera. So here we go. The first question last time was, what effect does the sale of stock have on earnings per share and ROE? And I asked you to explain it briefly. Okay, earnings per share, I broke it down the way I answered it anyhow. I broke it down. You wouldn't necessarily have had to break it down the same way, but earnings per share, it increases the number of shares outstanding, right? Okay, so if I have the number of shares outstanding, that's going to decrease my earnings per share then, right? It has to, because the math is that way, right? You got so much earnings. Your earnings don't change. If your share numbers go up, then your earnings per share goes down then, right? Okay, simple math there, and it's the same thing with the ROE. So ROE is return on equity. If I'm selling stock, I'm bringing in cash. I'm also increasing my equity. I'm increasing my assets. I'm increasing my equity. Okay, and so it increases my owner's equity or shareholder's equity. If I increase my equity, ROE is return on equity. It's net income over equity. So my denominator is bigger, so my ROE then becomes smaller, right? So in both cases, it reduces my earnings per share and it reduces my ROE. This becomes important in the second round. You know, we'll take a look at some stuff here, and it's also kind of a part of your assignment for round two. Yeah. Why did Eat and Fast sell so well relative to the competition? And then I say specifically, why did they sell better than Able? It wasn't price or age, and those were the two biggest criteria, because it wasn't necessarily the lowest price if we went back and looked at it, nor did it have the best age. Okay, I think the best age in the traditional category is 2, and it was about 2.5, and I think there was others that were about 2.2 or something like that. Okay. Positioning, I went down to about the third one, I think, and that was positioning. Might have been partly responsible. It was a little bit better positioned than was Able and some of the other competitors in that. But the biggest reason was just lack of production by Able. If we go and look at the traditional segment, and we will, there it is. Here's Able, and Able had a potential that was up here that was just about equal, right? But it didn't make enough, okay? Its actual was only 20%. Its potential was up here about 22, 23%. And so it didn't make enough. And each of these were able to take a little bit of advantage, not a bunch. But the important thing is that had Andrews made more, it would have at least reached its potential, which would have been about equal to Erie and pretty close to Ferris then, right? So that was mainly it in a nutshell, was this last one, lack of production by Able. So, okay. 3, why did Digby require an emergency loan? Now this one, for whatever reason, there's a reasonable number of you that put, well, they spent more than they took in. Okay, fine. Okay, that's not going to cut it. Heretofore, so you know, okay, it's not going to cut it saying that they spent more, right? You need to tell me, you know, what happened. Sure, I understand that they didn't make enough money to cover that, right? But what did they spend the money on, or, you know, what happened, okay? And in their case, it was several things, right? Go to the cash flow, right? The cash flow is right on there. And the cash flow is going to tell us the things that reduced its cash. 1, it didn't make any money. 2, it had a big increase in inventory, and so that has the effect of decreasing cash. 3, a little bit of accounts receivable. That one's fairly minor. 4, huge plant improvements, okay, and 5, they paid a dividend. Those were all negative contributors to cash flow. Okay, if you also put in there that their sales, weren't enough to cover that, that's fine. I mean, that's true. That would absolutely be a truism, and I certainly wouldn't have any problems with that. But unless we have, the other things, and the 2, and I put stars by them or asterisks, the increase in inventory and the plant improvement were obviously the biggies, right? Okay, they had 41 million in inventory, and they had 29 million or something like that. So that's $70 million right there in cash outflows that certainly weren't compensated for. So, okay, so that's how I want a question like that answered. I don't just want that they spent more money than they took in. Okay, that's not going to cut it. Okay, why did Ebb sell so well? This one came down to just something pretty simple: price and age. Okay, 2 factors. Ebb was, is that the low end? Ebb is the low end, yeah. So if we come down, Ebb led the market big time, right? Okay. Age is the second. Price is the first major factor, and age is the second major factor in the low end. So their price was $20, which was lower than everybody's. Andrews had a similar $20 price tag, right? Okay. But then you go to the second category, and for Ebb, it was age $5 or 5.6 in age, which is close to the customer buying criteria 7. Is it 7? Ideal age 7. Okay. Whereas Able or Andrews, they made some changes to their product, and so their age was only 3. So the top 3 actually had a nice age. Money on you couldn't say that money on marketing really had a big impact. Right, because there's, here down here, Dell spent, Dell 15 or $1.5 million in each of those categories, and wasn't even close in sales to up here. So price and age. Okay, pretty simple. Any questions about that? Okay, I haven't assigned grades. I went through. I don't know if you guys could read the feedback. I saved it in a draft format. I probably haven't published it yet. So I've gone through everybody's. I've read everybody's. I've actually entered the feedback, but I don't think I've published it yet, so you guys probably can't see it. So I'll be assigning the grades here today or tomorrow, probably, hopefully. Anyhow, don't be afraid if you get a not so good grade on the first one for some of you. Okay. Couple things. 1, I always throw out a couple low ones. 2, it's the start, and so I expect that we're going to see some low grades. I'll try to encourage you to do better as we go along, so don't be frightened if you see a grade that you go, oh my God. Okay? Let's go take a look then here. Let's see how. I have not yet applied the stats to my spreadsheet to see how this week turned out and see who the winner was. Do we have any guesses? Anybody want to hazard a guess as to who the winner might have been this round? Nobody wants to even guess. Wow. Okay. Do you guys get this selected statistics? Can you guys see this one from your dashboard? There's just a ton of stats on here. Come on. Most of which I don't use, but it's just easier to copy and paste the whole thing into the spreadsheet where then I break it down. This sometimes takes a while, so we'll see. Who are the top contenders? The computer teams. Did any of the student teams beat the computer teams? Don't think so? Okay, yeah, we'll see. It still hasn't processed yet. Come on, baby. We'll try again. Oh, there. Okay. I got a couple more to do, and then we'll be set. And these other ones are smaller, so usually they don't take too long to process. So. Normally I'll have this done. I just decided to wait because I thought this one was so close. I thought, yeah, I'll keep everybody in suspense, including myself, because the round, I think the ultimate scores are going to be pretty darn close here. So. Yeah, okay. One more. There we go. Okay. Hit save. Let's go see. Okay, so the first category is earnings per share. And Team Ferris, which was a computer team, got that, although Team Chester, look at that, Team Chester got number one for the student-run teams. That's pretty impressive. Okay. How about ROE? Team Ferris again, and then for the student teams, though it was Team Digby. Okay, so we've got Team Digby with a little higher ROE, Team Chester with a little higher earnings per share. By the way, Team Erie, which is a computer team, has not fared so well, so that's good to see. Contribution margin, ooh, Team Digby again, followed closely by Team Chester. Team Ferris really took a hit there, and Team Erie not so good. Stock price, kind of the same thing, Digby and Chester, 10 and 9. So right now it's kind of looking like Team Digby might have a little bit of a lead. We'll see here. Ooh, and then profits, Team Digby. So they expanded their lead maybe a little bit here. Team Chester still not too far behind. Cash flow, Digby had a good cash flow. Of course, they were so cruddy last time, you know, that they probably had a huge benefit from that, although Chester only lost a half point there. So now in terms of total points, look at that. Team Digby even tied Team Ferris, the computer team. So you guys are doing good. Usually it's not until the competitive rounds that we kind of catch up to the computer team. So I'm really impressed that we have a team, happens to be our distance team, but that they have caught up, at least at this point, to the computer teams. But now we got to see if there's any deductions, right? What are the deductions for? Leverage, working capital, and what's the other one? Emergency loan. No emergency loan except for Team Andrews. Who won last round? Oh, okay. Just kind of checking things out there. So you go from first, okay, Jordan's just nodding. Ooh, no deductions for leverage. And no deductions for working capital. So Team Digby is going to be our winner for the round. Okay? And still, they were tied with Team Ferris according to my spreadsheet. So that's pretty impressive. And Team Chester was not that far behind. So Team Chester had a very good round. And in fact, led in earnings per share. And one of your questions for this week is going to be, how in the hell did Team Digby have a higher profit, but Team Chester had a higher earnings per share? How could that have happened? Okay. Hopefully last week's assignment and some of the stuff I've talked about will lead you to find that answer fairly easily, right? All right, let's go take a look then, see what happened in the round. That's fun. That's a close round. That was good. I got kind of, when I first, I think I processed that when I was sitting at home Wednesday morning before I came to work, and I glanced at it and I go, oh, this is going to be close. This is going to be really good. So, and it was. I wasn't disappointed. So take a look at some of the stuff that's happened here. ROS, again, I don't get terribly wrapped up in ROS, ROA. Kind of interesting. Chester actually had a higher ROA than Team Digby. Team Digby had a higher profit, so what's that tell us about their assets? Team Chester has probably fewer assets, or at least relative to their profit, right? Okay. So also you would say that Team Chester is more efficient than in using their assets. Okay. Leverage. Digby had to be fairly close. 2.25. Andrews got dinged, but they were probably pretty close there. 2.25. This just doesn't round it, so they were probably just over the leverage amount. ROE is a big one. Ferris did have the bigger ROE, but Digby and Chester, those are both pretty good. What was the winning ROE last time? Wasn't it 10 or 12 or something like that? I don't remember in round one. Okay, but it wasn't that big. So we're seeing already a pretty good expansion in ROE, which again gets me pretty excited. Team Baldwin's the only team that really kind of fell by the wayside in terms of sales. Don't know what's going on there. Might be good to find out. However, every team made a reasonably good profit except Team Baldwin, but their loss was pretty minor, right? Pretty darn minor. They only lost $800,000, which wouldn't be considered a huge deal. Okay. Profits, EBIT, cumulative profit, I don't worry too about. SG&A to sales is kind of important, and this might have been partly what contributed to Team Baldwin's. And we could look at it one of two ways. Their SG&A to sales was very high, 16.9. The next closest is 11.7 over here with Ferris. Okay. They obviously, whatever they spent money on here, didn't effectively increase their sales, okay, for whatever reason. And we need to figure that out. If we're Team Baldwin, of course, we need to figure that out. Might not be a bad thing for other teams to kind of figure that out, though, too, so that you try to avoid that same thing, right? Okay. My guess is, their sales are so much lower, not picking on Team Baldwin, that they actually spent less money on SG&A to sales, probably significantly less than other teams when we get down and look at it. Okay, but they just didn't generate the kinds of sales. It might be a production issue. It might be a placement issue otherwise in terms of customer buying criteria. It could be some other issues. So things that we ought to look at. SG&A to sales, though, is fairly even along here. Erie was a little bit more, a little less. Okay. The contribution margin, which, again, I hold out to be extremely important. Here we are in the second round already, and Digby's already up to 35.8. That's pretty impressive. Yeah, that's pretty impressive. Now, a couple things can happen. When I say that that's pretty impressive, the thing about it is every game takes on its own nuances, and every game's a little bit different. Last semester, for example, I might have had a really aggressive bunch of students that were aggressive in terms of pricing. So they might have been driving the price down, and contribution margins might have been in the 20s. But if everybody was doing it, they had to do it to keep pace, and so it might have driven down that contribution margin. So every game takes on its own, its own persona. I've had other games where people just push the heck out of the marketing side, and one team would lead the way, and then all of a sudden the other teams would have to follow and catch up, and so we're spending all kinds of money on the marketing and sales, and so it's fun to watch how each game takes on its own persona. No, but those are really good contribution margins. Look at that. Everybody's over 30. Andrew's a little bit under 30, but not much. And 30, I think 30 is a benchmark that the guide gives you. But I promise you that the 30 will be completely unacceptable even by the end of the practice rounds, and for sure by the end of the competitive rounds. 30 will be a losing number when it comes to contribution margin. I'm pretty confident of that. So. Stock market summary. So we've only got two teams that have not issued stock, Andrews and Ferris. And Ferris was one of the winning teams, of course. But Team Digby was one of the winning teams. And look at that. They got all kinds of stock outstanding. So it's going to be interesting to see how that plays out. I've asked you guys some specific questions on your assignments in regards to that. So might be kind of interesting. Again, I pointed out that while Team Digby had about $2 million more in profit, just about exactly $2 million more in profit than Chester, its earnings per share were smaller. So, okay, I will tell you that that's unusual. Okay, and I'll tell you for a couple reasons. One, which cheaper, debt or equity? Come on, you guys have all had me for finance and other classes. What's cheaper, debt or equity? Huh? Debt. Debt's always cheaper. Yes, thank you. Okay. And we see that Team Digby looks like the only team that also has borrowed substantially. Baldwin maybe some. Did you guys borrow some money?
The first round.
Long term?
Yeah.
Okay. Yeah, not short term. So. Okay. So we take a look at our cash flows. Digby obviously cleaned out a lot of their inventory, so now, and that's probably why they had a nice cash flow number, because they went from 41 million negative in terms of cash on their inventory to a 31, almost 32 million positive. So they cleaned out a lot of their inventory. That's great. Andrews had the opposite problem. Okay, they probably went from maybe having a positive number here, I'm not sure, but a big negative number, and so it contributed to negative cash flow in terms of their inventory. But we look here, wow. Okay, now Andrews, last round I was saying Digby, look at that. Digby had made a bold statement in terms of some of their plant improvements, but now, this time they've really backed off, okay? They've really backed off. And on the other hand, Andrews is maybe making a huge, bold move in terms of their plant improvements. So I want to know what's going on. Interestingly, with Team Digby, I think we couldn't absolutely see some of the stuff that was going on last round until this round, and I'll show you what I mean when we get down to it. Now, and I didn't put this on the deal, so it might end up on the assignment. What's it mean when Team Baldwin had a positive number in plant improvements? Don't answer that, because I think I'll add that to your guys' assignment, right? What's that mean? Everybody else either had a zero for Team Chester, but negative numbers here for everybody else, and Team Baldwin had a positive number, so it's kind of odd. Dividends paid. A few teams, 3 teams paid dividends. Interesting at this point in time. Sale of common stock. Team Baldwin sold a bunch of stock too. That's interesting. Okay. Team Digby sold some more stock, and Team Erie sold a little bit of stock. Long-term debt. Team Digby a bunch. Ferris and Erie a little bit. Retirement of current debt. So they had some big current debts from last time that they paid off. I don't think they borrowed. Oh, and then Erie and Ferris. See, Erie and Ferris, 2 computer teams, aren't afraid of borrowing money. In the short term, look at that, they 20 or 19 and 23 million roughly, right, between them. So, and then Andrews, the only team that had the emergency loan. So, cash, that's a lot of cash. There's a lot of cash on the books here, lots and lots of cash. Okay, for this time of the game. Maybe you guys are saving up to invest in something. That could be, but that, even 24 million, I would tell you, is a lot of cash at this point. Okay, and you've got Baldwin sitting on $46 million. So what are they going to do with their cash? By the way, on a related note, if you follow, Apple's earnings for the fourth quarter last year were really, really good. Anybody know how much cash Apple? It's the biggest company in the world. Anybody know how much cash they're sitting on? It's close to $200 billion. $200 billion in cash for one company. I mean, that's just an astounding number, right, that they'd be sitting on that kind of cash. Part of the problem with Apple, and it's a problem with a lot of American companies actually at this point in time, is that they're earning a lot of that cash overseas. And the United States has a really punitive rate for companies that earn overseas and they want to bring the money back to the United States. If they bring the money back to the United States, they have to pay a 35% corporate tax on that, which is kind of punitive, so they just leave it overseas, right? It makes it tough for them to spend it, though. What do they spend it on? What are they invested in? The only thing they can invest it in is then overseas plants and improvements and those types of things, right? Which they will, to a certain extent, but they're kind of limited as to what they can do. What happens if they want to buy some stock back, which Apple has done, or what happens if they want to pay a dividend? Often what they'll do is they'll leave the cash over there instead of using it, and they'll just borrow money. Okay, so it's really kind of an interesting issue that's going on with a lot of American companies. They estimate there's over $2 trillion that American companies have sitting overseas because it's there's big penalties if they bring it back. So what do you do with the cash? That was kind of my point. What's Apple do with the cash? what do they do with that? What do you do with $200 billion? Do you give that back to your shareholders? Do you invest it? What do you do? In the early days of an Apple, and when they were just going, it was easy to say, you know what, we're going to spend our cash on research and development, or we're going to buy other companies. Google's done the same thing, right? Buy YouTube and those types of things. Microsoft used to do that all the time because they used to sit on hordes of cash. They still have hordes of cash. Microsoft's probably got $60 or $70 billion too, right? Okay, but what happens when you run out of those things? Right? Okay. Have you guys run out of those things? Right? Have you run out of research and development? Have you run out of plant improvements? Have you run out of those types of things that you could do? Okay. That's for you guys to figure out and answer. Right? Or are you guys still in the early stages? Are you Apple, 15 years ago? Are you Microsoft 20 years ago? And trying to figure out what to do with some of this cash that's coming in. Okay. Accounts receivable out. Inventory, we see, everybody's got some inventory on hand. Andrews, especially. Are those huge amounts? Maybe not too bad. We'll take a look when we get down below on the production analysis and see what that says. Size, so total fixed assets. Boom. Team Erie constantly has been making some improvements. Team Andrews, with their huge investments this time in plant improvements, they've got some big fixed assets. Those two teams do. On the other hand, you got Baldwin, just maybe going small. There's nothing wrong with small ball. It's an interesting strategy that can be effective. So total assets, though, keep in mind that while Baldwin has low fixed assets, look at all the cash they have compared to other people, right? So their total assets aren't that much smaller, but that's an easy fix. It's always easy to get rid of cash. Okay? It's always easy to get rid of cash. There's always people who got their hand out want cash, right? So, okay. Accounts payable, current debt, long term. Then I come down here. I like to look at the equity and see where we're at. Okay, we've got Team Digby has the highest amount of equity. Well, is that a good thing or a bad thing? Most of the time we say that's a good thing, right? But how does that affect your ROE? Okay. And so the answer is, the other side of this is if you don't have enough equity, then you have too much leverage, and so you get dinged for leverage. And so there is a sweet spot. Okay, there's kind of a sweet spot that you want to look for in terms of that equity number, right? And that's obviously changing because we got growing companies, right? Growing demand, growing companies. Income statement, we take a look at. Remember what I said about SG&A? I said I'll bet you Team Baldwin spent probably similar to what other teams did, but their sales were so low. And you can look at that, yeah, right in the ballpark, right? In fact, Team Erie actually spent less than they did and generated, Team Erie spent less than them and generated $136 million in sales. Team Baldwin spent $13 million here and only generated $79 million in sales. So depreciation, that's going to be a reflection of our fixed assets up above, so we've kind of actually already looked at that. Right, you're going to have more depreciation if you got more fixed assets. We do see that Baldwin's and Ferris, a little less depreciation, so a little smaller maybe that they're looking at. So interest, that reflects what we borrowed, so we've kind of seen that up above too. Taxes, profit sharing, net profits. TQM, does that start in round 3? Okay, TQM starts in round 3. I want to talk a little bit about that before you guys make TQM decisions. You'll have the ability to make those decisions. Pay close attention to, and I don't know if it shows up when you're working on the online worksheet, but if you're looking at the Excel worksheet, those little pop-up things with a little red triangle up in the corner, pay really close attention to those on the TQM. It tells you what kind of return you can expect, okay, for an investment in that particular category. Okay. That's really, really, really important. Okay. Now, TQM, I'm going to tell you, is going to show up here. It says fees, write-offs, TQM bonuses. There's not a lot here right now. I don't pay much attention to this right now. But when TQM starts, I'll start paying attention to this. I'm going to tell you a good and bad about TQM. Okay. If we're investing in, I'm going to say automation. Okay. If we're investing in automation, is there really much of a cost? The answer is no. Okay, all you're doing when you're investing in automation is you're trading one asset for another. You're trading cash for automation, for equipment. You're trading cash for equipment. That's it, period. Okay, so there is no cost that really shows up. There's no expense, technically, other than your depreciation is going to increase somewhat, right? But otherwise, it's pretty much a direct trade. Other than your depreciation is going to go up a little bit. That's that's something to really keep in mind. That that doesn't really affect my expenses all that much. Now, TQM on the other side is going to be listed as an expense. Okay, so if I spend $15 million on TQM, it's going to be $15 million against my earnings before interest and taxes. Boom. Okay, if I spend $15 million on automation, it's not. That's going to increase my depreciation a little bit. I don't know, maybe $1 million or something like that, right? Okay, that's the only expense then. But when I spend money on TQM, it's going to hit my expense. Now, when you look at those little red triangle pop-ups and stuff, though, you're going to have to see how it's going to impact some other areas, though, in terms of cost savings, in terms of one of the big ones is R&D cycle time. Okay, it's big depending on what your strategy is. You have to try to incorporate like the R&D cycle time. If you're a high end, if you're a niche high end, that's extremely important. If you're a low cost, low end, niche low end, it's not so important. Okay, but you need to kind of look at all of those things, and you got to kind of feel them out and see how they fit your strategy, right? Because it'll pop up and it'll say, hey, this one, if you invest in here, it's going to reduce your material cost, or it's going to reduce your labor cost. That might be more important if you're a low-cost provider than if you're a differentiator, right? Okay, so those are the types of things you're going to have to weigh. It also gives you ideal amounts to invest, right? It's one of those things where I've seen people make a lot of mistakes plugging in the number. They'll plug in $100, which would be $100,000, but if you read the thing, that's not going to do you anything. Okay, and it'll even show you that it's not going to do anything, right? Okay, in most cases, I think it tells you got to spend at least, maybe $750,000. I don't know what the number is. It'll tell you though. Okay, so pay attention to those things, and then watch, because it kind of gives you an idea of if you spend $1 million in this, it's going to cut your labor cost by 6%. It'll show you. Okay, so watch and make sure that the number that you're putting in is actually having an impact over here. If it's only going to reduce your labor cost by 0.01%, who cares? Okay, if it's going to reduce your labor cost by 5 or 6 or 7 or 8%, that can be a big deal, right? The other thing to keep in mind on TQM is that those advantages stay with you for the rest of the game. Okay, so while your $15 million expense, you're probably not going to recover that in the first year. You may have recovered it by the second year, and by the third year, then it may be contributing greatly to your profit. Okay, so this is one of those things that in the practice rounds, you're going to look at and you're going to say, yeah, do I want to incur that kind of expense when you're only going to have a couple more rounds? In the competitive rounds, you're going to have 5 more rounds, right? So you got to keep those things in mind, because if it saves you 6% on your labor, right? You spend $1 million and it saves you 6% on your labor cost. Maybe your labor cost, maybe that saves you $300,000. Well, so 3 years it takes you get your payback, and that's wonderful, right? But if you had another 3 years on top of that, then your return is really, really good. Okay, so really pay a lot of attention when you're looking at that TQM. Taxes, profit, interest. Okay. We see 3 teams here that have started to push their capacity a little bit. Starting to push their capacity. Remember, you can go double. So, Ferris, which looks like they might have shrunk up their capacity big time. Okay. So Ferris might have shrunk their capacity. Their capacity looks to be about 3,000 total, or 3 million units, and they're up to 5.5. So they're almost at full capacity. When we look at their production analysis, we're going to see that they're pretty close to full capacity, right? Every other team, Baldwin, Chester, Digby, just all kinds of capacity. You guys just got capacity dripping off your tongues, right? Just hanging out there, okay? Andrews is using some capacity. They produced a lot. Might be why Andrews has a little too much inventory. Could be. Because they're producing way up here, way more than any of these other teams. And so that might be one of the reasons why they ended up with a little extra inventory. So we look at inventory. Look at that in the traditional segment. Wow. But I'd sure keep that in mind. Because you bounce down, you got 900, 900,000, 700,000, a million. So there's 2.6 million, 3.2 million, 3.3, 3.4, 3.8 million, sitting in inventory in the traditional segment. If you look at that now on the low end, 0, 0, 0, 0, 0. Oh, everybody sold out in the low end. Interesting. Okay, high end, a little hit or miss there, right? A couple teams have some, but not a bunch, right? Performance, 0, 0, 0, 0, 0, 0, 0. So performance, we might have everybody sold out too. So interesting. You start to see some of these things taking shape. So I like to look at this column. Oh, there is some performance right there. Andrews is the only team that had a little. So we didn't completely everybody sell out. Andrews had just a few, and that's almost perfect, right? You got a few left in inventory. Wonderful, right? It looks like what got Andrews in terms of their inventory was the traditional and high end. Cake had a lot left in just the traditional, or Chester did, sorry. Huge in the traditional. So a lot of people went big in the traditional segment. Okay. What happened, though, in the traditional segment? Yeah, that's interesting. It kind of looks like everybody tried to go big, and the demand just wasn't quite there, so we'll see. I thought I must have been dreaming because I thought there were some other products that ended up in the traditional segment, but obviously not. So I must have been laying awake one night dreaming about something. God, isn't that horrible? Man, dreaming about your guys' cap sim games. Oh. Okay, this is a great place to come back to make some comparisons. Oftentimes when I say, gosh, how is their pricing? Well, in the low end, let's see. Geez, Andrews was 23, 22, 23 and a half, 22 and a half. Ooh, look at Erie. Looks like Erie got a little bit aggressive in the low end, right? They're down to 19 and a half. They still got a 32% contribution margin, so that's pretty good. They've bumped up their automation, okay? And I wonder if they increased I'd have to go back and check, but I wonder if they have since the start of the game. I don't know if it was in the first round or the second round that they increased their capacity. Okay, so their capacity first shift's 2,000 or 2 million, so they can make 4 million units in that category now, in that segment. Look at Andrews. Okay, I asked you, what did Andrews spend? They had plant capacity or plant improvements, right? I asked what they spend it in. They obviously spent a little bit here in terms of capacity, right? Can we see that up here? A little bit. Team Digby has increased capacity, and it looks like Team Chester has increased capacity. I would guess Team Erie and Team Baldwin have left their capacity pretty much. Baldwin's actually this round, you can tell, has reduced some capacity in certain areas, so it's interesting. It looks to me, I think Team Chester, I think that's exactly where we started, so I don't think Team Chester has messed around with their capacity at all. So you could use them as your comparison. Otherwise, you'd have to go back to the other round. And that's fine if you get two computers going or got your laptop going and your computer. It's pretty easy to bounce back and forth and take a look. On here, if I just got the one up, it's a little more difficult. But this report, I spend a lot of time. Of course, I spend a lot of time on the income statement. I spend a lot of time on this report, just kind of looking things over. Now, I said that we might see for Team Digby that they spent some money, because they did. Remember, they spent a lot of money on plant improvements last round, and maybe we'd have seen that a little bit over here, but look at this. So 1, 2, 3, 4, 5, 6, 7. They've got 7 products, so they're introducing a couple new products. Ding and deal. Okay. Now, they didn't give those products a lot of capacity. It kind of surprises me over here, right? So maybe they're introducing them, but a little shy about introducing them because they won't be able to make 100,000 items of each. That's a little bit surprising if you're going to introduce a new product. And I'll tell you why, because what happens when Apple introduces a new iPhone? What do people do? They go crazy. They camp out for 2 days ahead of time, the idiots, right? So they can be the first one to get their hands on this new iPhone 6 or whatever the hell they're at right now. I don't know. iPhone 77 or maybe it'll be 007 or something will be the next one. I don't know. Okay, they camp out, and so because there's a new product being introduced. So Digby's got a couple new products that are going to inspire some folks. We could look at where they're going to be placed, because here's your performance coordinate, and here is your, well, that seems really, really small on that one, on the performance coordinate, and then here's your size coordinate, which is, that's going to be an interesting placement for that one, right? So kind of small, but very not very high on the performance. So maybe it's going to be in the size category, would be my guess. And then this one, Deal, is got quite a bit of performance and a reasonable amount, or reasonably small. You know, maybe that's going to be a high end. I could go look. We could go look at the perceptual map and lock that in and know exactly where these products are going to appear. Okay. And I'm not so sure. I'm thinking that they should have been able to sell some this last round, so I don't know if they didn't actually order any production maybe. Okay. Introducing a new product is I'm going to tell you right now, it's really a great idea, but follow the steps. Follow the guide, because it takes you a round or so to get that thing put in place, okay, and to make it work properly, you want to make sure you follow all the steps. I'm guessing that Digby might have missed a step or so in here. Same thing. Okay, so maybe it will be next round then. So they might have just started introducing it this round, and it'll be next round that they can sell it. Okay, so they might be doing okay. I might be wrong about missing a step there. Okay, okay. Now again, I'll remind you that, or I'll say, you know, look at their performance and their size. So they've beefed that thing up. That thing's gonna come in at the high end, right? Okay, it's gonna have a certain amount of demand just because it's new. Okay, without having spent a lot of marketing and all those other things, it's going to have a certain amount of demand because it's new. Not only that, what else? Anybody know what else happens to Apple when they come out with the new iPhone 6? What happens to sales of iPhone 5? They'll actually kind of go up. Okay, because you get all this, you know, all this demand, and then you got people like me. Okay, well, I don't have an iPhone at all, but you got people like me that if I was going to buy something, okay, I'm going to buy the second or third generation, or I mean the older one, second or third old one, because I want something that's kind of tried and true, and more importantly, cheap, right? Because I'm a cheapskate. So their sales actually improve a little bit. So it kind of, because there's just more in the marketplace. I mean, everybody just sees that. So, okay, so spend a lot of time on that report. Now we come down and we look at these things. Always look at that even. Everybody met their potential there in the traditional segment. And remember, in the traditional segment, we had lots of inventory left over, though. You know, so we got lots of inventory left over, which again we have to go up here to the production thing to see what that inventory is. Okay, what did I say? 3.8 million units. And next year the demand is going to be about 10 million, something like that. So keep that in mind. You know, you want to keep that in mind when you're making your projections for next year, right? Okay. Low end, I want to come down. Low end is a little more all over the place because look at that. We met demand. We filled the demand, but partly because we filled it with other products, right? Looks like some of the traditional products, because we had lots of extra traditional products, but it looks like some of those sold in the low end just to help fulfill that. As we get further and further apart, that's going to be more difficult for that to happen, right? Okay, but look at that, 1, 2, 3, 4, 5, 6. So everybody sold out of their their true low end product, right? And it looks like Digby and Erie and Andrews and Baker and Chester, but especially Digby and Erie, you know, they really took advantage. They were able to sell quite a few of their traditional products, right? I mean, that's pretty good. You sell 300,000 products at $27.50 in the low end just because we didn't make enough low end otherwise. Okay. And then kind of all over the board here, you know, Baldwin left some money on the table. Andrews really took advantage. So Andrews would have really sucked if and Digby too. Look at that. So you guys, especially Ferris, Erie, and Baldwin, you guys let Digby win. Digby didn't win on their own. You guys kind of let Digby win because you just didn't make enough, right? Might have been part of Baldwin's problems in terms of total sales. At least that would have contributed partially. You know, they gave up 4%, it looks like, of that. So, you know, they gave up 400,000, 400,000 or 500,000 probably in sales. You know, $20, so it's $10 million, right? Ferris gave up a bunch there. Okay, looks like Erie's kind of dominated that low-end market, maybe just because they made more. I don't know. Well, they do have the lower price too, though. So age is good, right? Baldwin was down here. You know, age isn't so good. Price was okay. They didn't spend a lot of money either, but they still, look at that, still would have had, you know, more potential. Even given the, you know, and you could have obviously increased the potential by doing some of the other things. So you got in the high end. That's interesting. Erie has abandoned the high end. Okay, so what's Erie's? You know, I said after a round or two, sometimes then we can start trying to determine what a company's strategy might be. What do you suppose Erie's strategy is? Probably they're not doing much here in performance or size either. So it appears to me like they're going to be a niche low end, right? It just appears that they're going to be a niche low end. I can't say that 100% sure about that, you know, but I start trying to figure that out, and so.
Is that why in capacity they just had one there? Is that what you have to do? Like, sell your
Yeah, the question here is that why they had capacity of just one, and in their performance one? Yeah. That's a good question. I'd missed that when I was scrolling down there. What that means that they're doing is they're going to eliminate this one. Okay, they're eliminating, so they will not be competing in the performance category for sure next round. Okay, what you want to do if you're going to eliminate one like that is what they did. Okay, if you read the guide, it tells you if you take it down to 0 right away and you have any inventory, they don't at this point, but if you have any inventory and you take it down to 0, it immediately cuts your price in half, and it sells out your inventory then, just to get rid of it. Okay, if you instead lower your capacity to 1, then you're going to sell it at the normal price and hopefully get rid of your inventory at the normal price so you don't lose a bunch of money on it. And then the next year, you know, they'll get rid of this one capacity next year, so it'll be gone. No big deal then, right?
So what if you didn't have any units in inventory and you dropped your capacity?
And you wanted to get rid of it then you could drop it down to 0. That's fine. Yeah. Yep. The question was, if you didn't have any in inventory, could you drop it to 0? And the answer would be, yeah, you could without any ill effects then. So, okay. So we kind of know what Erie, you know, we know what they're doing at least, right? Ferris, what are they doing? That's, you know, looks like they're competing in the high end. It looks like they're competing in the performance and size. So, you know, they might be a differentiator, might be broad, might be niche. I don't know yet at this point in time. I don't remember how they do in the low end, not too bad. Traditional, yeah. I'm gonna. It's hard to say right now if they're broad or niche. Okay, they could be life cycle because they did just introduce another product too, though. So they might be that life cycle differentiator. They're not a low cost, I don't think. So, okay. So where were we at? High end. We met demand. We got Chester, Digby, Ferris kind of dominating there. Baldwin again gave up some money in the high end. Okay. And maybe Baldwin's getting out of those. I don't know. Performance. Erie again, kind of leaving that market. They left a lot on the table. Okay, that's a case where they're leaving the market. They're down to 1, but they left a lot on the table there. Ferris dominating. Like that, just absolutely dominating that performance segment. But you can look at where Ferris is situated, right? Ferris has aggressively kept their product to the forefront. Okay, I'm guessing that their MTBF is probably at the high end there, and their performance and their ideal position. Okay, they're going to be tough to compete with. It's going to be hard for any of you guys out in here to push your products enough without going past that 1-year time frame. It's going to be hard for you to push your products forward enough to compete on the positioning with them. Okay, it's not possible, and you're still going to, you know, there's still sales to be had there because, you know, Ferris has got what percent of the market? 32% of the market, so there's still 68% of the market to fight over, and we know that Erie's leaving. Okay, so you got 5 teams that can divide up 68% of the market, so there's still a lot of market there. But pushing it and trying to catch up to Ferris is going to be a little bit difficult. Again, that's where that TQM thing, though, if you're competing in that area, and when I talk about reduced cycle time, okay, that's what that, when you're making your R&D decisions, if you guys have looked at that, it changes your revision date, right? Okay, so let's say just under normal circumstances, you make decisions that push that revision date till December of the next year. Okay, and you don't want to go past December. You don't want to go into the following year. So we're December of next year. Okay, now you can go into TQM and make some investments that might reduce your cycle time by 25%. What's that mean? Well, that means that instead of that revision date then being in December, that revision date would be back in September. Okay, which means that also that then you could even spend more money to improve that product more, to push it further along that space-time continuum, or whatever the heck we would call that, right? So you could push it back out to December, and you could move it further in the direction, right, that you need it to be. So that's where that cycle time, when you see that one pop up, you're going to look at that and say, why the hell is that important? That's the reason that that's important, because it'll allow you to, that's why I said if you're in the high ends, competing up there, it's probably more important to you because you want to be pushing that edge. And in the size category, Andrews, look at that, that's kind of odd. Andrews, Chester, and Ferris are competing there. Boy, we got a big old, everybody's kind of all over the place there, right? Interestingly. Okay. Ferris still has 30% of the market, so again, they're pushing the edge out here. They had to have started in the round one. They had to have started pushing the edge to be able to stay out there, because when I say it's difficult for you guys to catch up, it's almost impossible for you to catch up to these guys, because otherwise you're going to go too far forward. Your revision date's going to be too far forward, and you'll really screw yourself if you get your revision date too far forward. So it's going to be very difficult for you guys to do that, minus some investments in TQM and those things. So here's where we could figure out. I said Baldwin left money on the table in what category? Was it the low end? So we can come and take a look. Low end's my second one here. So Baldwin's total, this is actual, this is potential. So Baldwin's potential here was 12.8, and they sold 9.3 in the low end, because they sold quite a bit of Baker actually. So they left 3.5% of the market on the table, right? So you could actually then go up and do the math, and you'll be expected to do this later in the semester. You'd go up and do the math, and you'd say, okay, so 3.5%, the total demand, I'm going to use a rough number, let's say it was 10 million, so that it's easy, right? So you left 350,000 units of sales on the table that you didn't get at 20 bucks, $7 million in sales you left on the table, okay? Even a little later in the semester, I'm going to ask you to then tell me what the lost profit, earnings before taxes anyhow, would have been on that same, on that same amount, okay? So just some things to kind of start thinking about and kind of taking a look at. Understand the math here. I kind of just do it in my head when I'm up here looking at these things a little bit. Andrews, on the other hand, got to take advantage here, right? Their potential looks like it was about 14%. This looks like they sold about 22. So, I'm sorry, looks like they sold about 17, and their potential was about 14, so they gained about 3%. Do the math the same. 2.7 million, so they sold an extra, whatever that would be, 60, 70,000 units, 30 some bucks a unit. The perceptual map. Look at that, it's really getting strung out there along the main axis, if you want to call that an axis, I guess. It's really getting strung out. We see where their new products coming in was Fox, their new one, right up here at the front edge. Okay, foam and fume, they're right out there in the front. Even their fist product in the high end is far ahead of everybody else. Deal is coming in towards the back end of this category. That's kind of interesting. And then they had another one that's coming in down here someplace. No, it was over here. Ding. So that's coming in that size one, but again, kind of in the back end. Okay, I'm going to tell you, if you're going to introduce new products, you want to be there. Okay, you want to be there. You want to be there. Okay. HR, you guys were able to make some HR investments, and what has that done? Not a lot. Okay, we do see that Team Baldwin is going to generate 1.3% productivity savings. You know, apply that to your labor cost. So if you're saving 1.3% on your labor cost, that's not a heck of a lot at this point in time. Okay, not a heck of a lot at this point in time, but if you get this up to 120% and you're saving 20% of your labor cost, you know, go up and figure your labor cost. What's that, $50 million or something like that, $40 million? All of a sudden you're saving 7, 8, 10 million bucks a year. Ooh, could be a good thing, right? Okay, so that's something. This is something that you'll see some teams, and again, it probably depends on what kind of strategy you're pursuing, but you'll see some teams really push this here in the HR side. Our computer teams didn't really push it, didn't gain a lot. Okay, it looks like they gained their productivity because of the training hours. Okay, you also in the recruiting, I think you save some money in turnover expense, if I'm not mistaken, because your turnover rate becomes less. And so they spent, you know, a decent amount of money here in recruiting, so they had a little lesser turnover rate. Of course, they got fewer employees, I think, but separated employees because you cut production. TQM will show up. Okay, next time. Here's the examples. You know, down here it tells you the things that you can save money on: material cost, labor cost, reduction in R&D cycle time, reduction in admin costs or administrative costs, and your demand increase. So you can actually increase the demand for your products as well, depending on your investments up there. So, any questions? None? Everybody totally understood what happened that second round? That was a good round. That was a lot of fun. Let's take a look at this week's assignment then. And I said I was going to add a question. What was that? You guys remember? Yeah, it's about Baldwin and, oh yeah, and plant improvements, yeah, 4. Question number 4. Oops. Why did Baldwin have a positive number in plant improvements on the cash flow? Okay. So Digby had the highest profit, but Chester had a higher EPS. Why? That one should be relatively simple, I would hope. So then, because so many people kind of whiffed on this same question for round 1, I just did it again. Why did Andrews require an emergency loan? So please take a look at the the cash flow and give me all the reasons, right? 3, Andrews spent $35 million for plant improvements on what? So now I want you to dig in. This is one of those cases where you might have to go back and look at where they were in round 1 versus where they are in round 2, right? And again, try to be as complete as possible. Okay, so plant improvements could be in different areas, right? So, and then 4, why did Baldwin have a positive number in plant improvements on the cash flow, which we kind of talked about. So, any questions about that assignment? That'll be due Tuesday. Yep. That'll be due Tuesday. So I'll send out both the spreadsheet and the assignment probably right after class. So I'll try to get those sent out so that, and then I'll try to get the grades entered for number 1. Yeah, just to give you an idea where you're at there. So, okay. There was, some that were really good, some that were a little disappointing. Again, those will improve. You guys will get a better understanding of what I'm looking for. So don't be depressed if your grade on this one's a little bit disappointing. And I'll always toss out a couple of them. Okay, by the end of the semester, anyhow, a couple of low ones. So, any other questions? Okay, see you Tuesday for round 3.